Hi, everyone. This is Jason Bjerk of Wall Street for Main Street. Welcome back for another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. He is former hedge fund manager. He also runs a paid newsletter right now called the Felder Report. He's interviewed a lot of big name investors. He has an excellent analysis here of value investing. Jesse Felder, thank you for joining me again.
Sure thing, Jason. Good to be with you.
So, Jesse, we're recording this interview on Monday, May 19th, 2025. The Dow is the S&P 500 is almost back at 6,000. The bond yields on the 10-year US Treasury got, I think, above 4.5% last week. Late Sunday night, it hit 5% on the U.S. credit rating downgrade. I want to get your thoughts, though, on the bond yields on the U.S. Treasury in Japan versus the stock market. Have you seen a situation where the bond yields can rise and the stock market can also rise, or is this really, really rare?
I don't know how rare it is. I mean, I basically look at real interest rates, essentially TIPS yields, versus the yield on equities, and I think that's the appropriate comparison because equity yields are real yield, and so you look at like a TIPS yield to compare it. On that basis, stocks haven't been anywhere near as expensive as they are today for a very long time. TIPS yields right now would suggest that the equity risk premium is as low as it ever really gets, should be significantly higher. With the 10-year TIPS yield essentially 2% and the earnings yield like at 4%, that 2% premium is nothing compared to what we've seen in the past. Now, I will say that it was around this, or even did get more extreme during the dot-com bubble, right? TIPS yields were relatively high back then, and the earnings yield was about roughly lower, a little bit lower than it was today based on like a trailing price to earnings ratio. So yeah, I mean, it's basically like a bubble type of environment when you look at how are equities priced relative to real interest rates. Now it's if you're just looking at nominal rates, a 4.5% yield on the 10-year. I think, and even on the 2-year and shorter, you got 4% plus, which is really attractive. And I think that's the area where, I think investors may be making a mistake. I'm not bullish on longer term bonds. I do think that this uptrend that we've seen for the last, couple of weeks, could probably continue. I think right now it's, the bond market is saying, hey, look, what you guys are trying to propose in Congress right now is not going to fly with bond investors, right? If you're going to grow the deficit by $3 trillion over the next decade, that's not going to make people want to buy these bonds. So, but I think there's a really strong reason why Warren Buffett is the largest holder of Treasury bills right now. I think he owns 5% of the entire T-bill market. He wants that short-term guaranteed yield without taking any duration risk whatsoever, and that's way more attractive than owning stocks right now.
Have you seen a scenario where the bond yields could potentially keep rising and then the stock market also rises, or do you think one of those two things are going to have to change dramatically?
No, if rates continue higher, what we've seen is, pretty much every time this 10-year yield starts getting close to 5%, stocks sell off, right? We saw it in like late summer of 2023, and that was, we saw a top in the stock market rolled over for a couple of months before bottoming in October or something. So I think if we do push back up higher above 4.5%, it'll start to put pressure on equities, especially with the fact that the forward, guidance on earnings looks really bad right now. So, you have the combination of a potential disappointment on the earnings side over the balance of this year. At the same time, risk-free, quote unquote, risk-free rates pushing higher would be, I think very difficult for stock prices to continue to move higher.
So despite this credit rating, and if the dollar gets weaker on the dollar index, do you think that the stocks could continue to rally, or do you think that the credit rating will have some type of impact on the stock market?
The credit rating, right? Obviously, we saw, the news came out Friday and stock market opened real weak, bonds opened weak. and essentially reversed those gains, those losses during the day. I think what Moody's is saying is something that everybody already knows, is that the trajectory of the fiscal debt, the debt and the deficit is not sustainable. Ray Dalio has pointed out that 6% deficit to GDP, you're headed for a debt crisis. It needs to be closer to 3 to be anywhere close to sustainable. So I think what Moody's was really trying to do, John Authers pointed out this in Bloomberg today, is that Moody's may feel like it's their job to just reiterate to Congress that the only way people are going to keep buying treasuries is if the dollar remains the global reserve currency. The Federal Reserve policy remains independent of any pressures by the administration. And as long as there are clear separation of powers in terms of Congress and the executive branch and judicial branch, kind of checks and balances, right? Without those things, whenever any of those things are threatened, it does threaten the demand for treasuries, and we've seen all three of those things threatened recently. So I think that's Moody's point, is saying, hey, look, to the extent that you guys want to ignore, these requirements, it's going to put a lot of pressure on the demand side for treasuries. And so I think that's really the message from Moody's.
And you mentioned Ray Dalio. I think Ray Dalio just put out a video in the last week, and he was talking about when he started his career working on Wall Street, that he thought when the U.S. got a credit rating downgrade in the early 1970s during the stagflation era, that he thought that the stock market would crash, but actually it created a weaker dollar and the stock market rallied. So things can work counterintuitively. The market starts to price in, I think, a weaker dollar with higher asset prices and nominal value, I think.
Well, if you look at the recent history of the dollar, let's just talk about the last few decades. When the dollar's in a major bull market, you want to own financial assets. You want to own stocks and bonds, right? Dollar bottomed in 2010-11, right around the same time as the stock market. And ever since then, it was a great time to own stocks and bonds. Prior to that, you look back at the dollar peak in 2002, and 2002 to 2009, 10, 11-ish was a 10-year bear market in the dollar. And it's not a coincidence that also was a lost decade for the stock market. What did well in that dollar bear market was commodities, right? You wanted to own oil, you wanted to own precious metals. So if we are going into another 10-year period of dollar bear market, which I believe we are, because the dollar right now is about as overvalued as it has ever been in terms of purchasing power parity, or any other way you want to look at it, then your investors are really going to want to favor real assets, commodities, precious metals, these types of things, over financial assets, stocks and bonds, which typically don't do well during a dollar bear market.
And I think to add your points there, I think emerging markets also tend to do very well when the dollar is relatively weak because they have dollar-denominated debt. And so they tend to get a boost with commodities rallying and then exporting into the U.S., although now with the trade wars and Trump and tariffs back and forth, not so sure that that's going to be the case now. But in the past, when there was a weaker dollar, emerging markets tended to also go on a run.
Yeah, I think when you look at what are the true goals of the tariffs, I think one of them is a weaker dollar. Now they're never going to come out and say that, right? They can't say we no longer have a strong dollar policy, right? That would cause all kinds of problems. So they basically are saying, and they're. Yeah, I think this is a major part of the negotiations, even if they can't really say it out loud, is they want a revaluation of foreign currencies versus the dollar to the upside, especially in Asian currencies. The yen, the yuan are significantly undervalued relative to the dollar, and that's one of the things that the Trump administration has talked about, is they want U.S. exports to be more competitive on a global stage. How do you do that? You need a cheaper dollar, and you need a stronger overseas currency. So I think that's really one of the key pieces of these negotiations that are happening, is, okay, we'll lower tariffs so long as you allow your currency to appreciate to a certain degree. And so, yeah, and And in that context, right? I mean, those countries are probably going to be forced to ramp up, fiscal stimulus as part of that. Deglobalization and tariffs are generally not good for economic growth. So to kind of counteract that, you're going to need some fiscal stimulus, which goes along with the idea that the U.S. wants to spend less on defense and on defending these major trading partners. So they're going to be more responsible for their own defense. They're going to be more responsible for their own economic growth. That's going to need fiscal response and stronger currencies in those areas. So yeah, I think it is bullish for commodities, broadly speaking.
Would you say that this type of situation that they want to set up with a weaker dollar, is this similar to the Plaza Accords? Because if I remember correctly, when I was studying the Plaza Accords, they thought the dollar was too strong then, and they wanted to negotiate with their trading partners to strengthen the other currencies and help somewhat weaken the dollar back then.
Yeah, I think it's more similar to 1971, the Nixon shock, where if you read about that time, Paul Volcker was very, very concerned with the amount of gold that was flowing out of the Treasury. He basically said, we have to put a floor here. We cannot allow this to get down below $10 billion worth of gold in the Treasury. And it was getting closer and closer to that as foreign central banks and stuff exchanged dollars for gold. And they needed to essentially rein in fiscal spending to kind of reverse that or close the gold window. So what they ended up doing was closing the gold window. Nixon imposed 10% across the board tariffs, very much like Trump just recently did, and open negotiations to revalue the dollar lower. So I think it's very similar to what we saw back then. In fact, Jamie Dimon mentioned this today in a speech, that it's very similar to that 1971 episode. So if you think that's true, then you look back. Okay, what happened in 1971? It was a lot of the similar stuff. Close the gold window. Inflation was only beginning to become a more serious, longer term problem because there really wasn't the resolve to tackle it in a meaningful way. And the stock market peaked in 72 and went nowhere until 1982. So essentially sideways. Adjusted for inflation, it was much, much worse than that. So I think we're in a similar situation right now where the goal is to we need to address our fiscal situation, but it's a lot easier to try and just impose tariffs, negotiate currency revaluations and these things, which is what they're attempting to do right now.
And in the 1971 to 74 period, because they started installing COMEX contracts, I think that was the first time in decades that they had actually allowed a gold futures contract to actually be traded back then. If I remember correctly, the gold price, when it was allowed to freely trade back then, it went from, I think, $42 up at one point. It got to, what, 800 something dollars. So it went almost a 20x move. Now, I don't know if we'll see 20x, but I can tell you we're seeing record gold demand right now from non G7 central banks and Asian retail investors.
Yeah, and the typical gold bull market, you see a 10x move. So if you think this gold bull market bottomed around $1,000 an ounce back in 2015 or whatever, it's not unreasonable to think 8 or 10,000 is achievable a few years from now. I'm a longer term gold bull. I think we're in the middle innings of a longer term bull market, but I think we are probably in the short term going to go through another kind of consolidation phase, similar to what we did from kind of that 2020 to 2022 time period, and also in that 2016 to kind of 17, 18 time period where gold has these beautiful runs and spikes higher and then kind of just consolidates sideways for a prolonged period of time. And I think we could be, in more of a consolidation phase now in the short term.
Yeah, I agree. We could have a consolidation phase, but what we're seeing now with actual gold producers is they're taking that free cash flow that they have, those good profit margins, free cash flow, and either they've been buying back their shares because on a net present value, future discounted cash flows, they think that their shares are cheap on a valuation metric, net asset value, or they're going and doing mergers and acquisitions. So the industry, instead of necessarily paying a dividend, is going and doing mergers and acquisitions, trying to buy relatively discounted assets right now.
Yeah, I mean, what we don't want them to do is go overspend at the wrong time like they did in 2010, 11. And misallocation of capital is really kind of what hurt the sector back then. That's not necessarily what they're doing today. I think that yeah, if we are in the middle innings of this bull market, then yeah, probably using money to buy back stock in these things is a good use of the cash flow.
Well, also some select mergers and acquisitions depending upon what valuation. But you brought up the 2011 period, and actually, the average person doesn't know this, and my friend Rick Roll has talked about this a lot. Is that the costs were actually rising as fast or faster in many cases than the metals prices back then. So the industry was not having the profit margins and the free cash flow back then, and they were still overpaying and doing bad acquisitions that they wrote down years later. They wrote it off at one point, write downs, Jesse, for bad deals over $70 billion, I think, from like 2011 to like 2018, give or take, during the bear market, and a lot of the senior gold mining CEOs were fired.
Yeah, really, I think to me the bigger, longer term driver for these kinds of things is the capital cycle. And when you see a group, like these companies, which was starved for capital for so long, right, through that bear market from 2011 to 2015, 16, they were starved for capital for a long period of time, and that really is what you need to get the bull market on the other side of that, right? Because when there's lack of investment, right, that means there's going to be lack of supply at some point in the future, and so when demand picks up, there's a mismatch, and that's very bullish. Now, the flip side of that is when you see a capital cycle with massive spending, right, that usually means there's going to be an explosion in supply, which is very bearish, kind of overwhelms demand going forward. We saw this with the fracking companies, during the early 2010s in the wake of the great financial crisis, when their debt costs got so cheap, they took on tons of debt and used it to just build out zillions of wells, right? And so you have this huge
That weren't
supply
profitable,
increase
yeah.
in production, and that overwhelmed demand, and then you get a crash in the oil price 2016 and a bear market that lasts for a number of years. But then, the energy sector is another one that's been starved of capital really for the better part of a decade now, and that has meant that there's going to be supply shortages, and you already see it, in their ability to produce going forward, even as demand continues hitting record highs, demand for fossil fuels. So, I think that the capital cycle to me is the most interesting thing to follow for those longer term cycles.
That's a good point there about the oil and energy prices. That would add to the gold miners right now with their profit margins, is that energy prices for diesel and oil and gasoline are relatively weak right now. So that's benefiting a lot of these gold miners for their input costs and profit margins. They don't have to worry about a huge run up at the moment, at least for the next couple quarters, in gasoline, diesel, and electricity hurting their profit margins. So that's a good tailwind for them right now for profit margins.
It is, one of the things, as a commodity bull, a believer in a commodity super cycle, I like to look at the ratio of the oil price to the gold price. And right now, the oil price has only been cheaper relative to gold at the 2020 lows when the oil price went briefly negative. Oil has, and that's the only time it's ever been cheaper relative to gold, than it is today. So, to me, that ratio suggests it's probably time to favor the energy sector over the precious metal mining sector, until you get a reversal in that ratio. If you look at that ratio over a long period of time, you see, spikes in the oil to gold ratio. Those steep spikes are a really good indicator that, hey, it's time to rotate out of energy and back into gold. And that has been some really good buy signals for gold over the past few years. But right now it suggests it's probably time to favor energy.
I'm still in favor of the precious metals, the royalty companies, and the low cost gold miners right now, because I think they're going to have this advantage for the next couple quarters. But I agree with you that from a sentiment perspective, I think oil and natural gas and the fossil fuel energy companies are very close to a bottom, because we're seeing contrarian indicators that whether it's capital expenditure cuts, I mean, these oil companies, Jesse, in the Permian Basin, on the earnings calls, they're announcing over $100 million in Capex cuts. and the drill rig count is falling like crazy. So eventually, this is going to affect supply. I don't think anyone right now can make good profit margins and free cash flow at the current West Texas Intermediate price. There was an interview with Harold Hamm. I don't know if you saw it out lately. He said basically the entire industry to be consistently profitable needs $75 a barrel West Texas Intermediate to produce oil in the U.S.
It's not just, the U.S. producers. I mean, you look at like the Saudi, fiscal situation, and they need higher oil prices too to kind of balance their budget and whatnot. So, in the short run, they can allow for lower oil prices to try and appease Trump and make a deal there. But longer term, it's absolutely not sustainable. And just from a sentiment standpoint, I'd point out, it was fascinating to me to see the celebrations, the media kind of threw for Warren Buffett's retirement announcement at the Berkshire Hathaway meeting a couple of weeks ago. Obviously he's had an incredible career, the greatest investing career probably anybody's ever seen. But at the same time, there were articles in the Wall Street Journal and Bloomberg saying, yeah, he's amazing, but this investment in Occidental Petroleum is just a curse. It's Greg Abel's just cursed with this horrible investment in Oxy, and I think it's just fascinating, totally ironic that people know what Buffett, what the key to Buffett's success was to be greedy when others are fearful when others are greedy. Everybody who's spent any time around markets knows that quote. But what they can't see in real time is that's exactly what he's doing in energy, right? He's buying what most people fear right now, and that fear was palpable in a lot of the coverage.
And 2 or 3 years from now, the cycle could turn and oil could have a bull market rally again after this bear market here. I mean, I think I agree with you that the bear market is being imposed. I think Trump, if you watch the business TV narratives, all the Trump representatives go on and say that the lower oil and gasoline prices will translate to the consumer price index and that will bring down inflation. They all repeat this verbatim. I've had friends tell me that they think that Saudi Aramco and OPEC are not cutting oil production right now to help out Trump, that he asked them for a favor to continue the oil production and not cut oil production. Because normally I think OPEC in the past, when the oil prices got this weak and this low around production cost, they would start to cut. The Saudis are getting hurt, though. There is pain there. Didn't the Saudi Aramco, I think they cut dividends substantially recently.
Yeah, like I said, it's not really sustainable for anybody. And really what I think, we may see is this opportunistic buyers. What we should be doing right now is refilling the Strategic Petroleum Reserve, right? It's the lowest it's been since it was really established back in the 1970s, 80s. So we should be refilling it right now with prices, but politically that's not really doable. I mean, you can't be looking as if you're kind of supporting energy prices right now. So, but the fact that we're not, and the fact that all this production is kind of being shut down, all this means is that there's going to be a bigger supply demand mismatch, a year from now, 2 years from now.
Oh, yeah, I agree. I think surprisingly, the data that's coming out is that the global oil inventories are actually down, I think 70 or 80% more than they anticipated. So they're drawing down the oil quickly. And then the other part I brought up is the capital expenditure. A lot of these private sector oil companies, the non-national oil companies, they're cutting their capital expenditure budgets enormously. So 9-figure Capex cuts. I mean, most of us that are familiar with mining or oil and natural gas know that eventually this translates into a lot lower supply and a bottom in the market.
Yeah, and then there are other sentiment signals too, like the Commitment of Traders report shows, managed money has essentially no position right now. They're the bottom of the range of the past decade. So, yeah, I think it's very clear. ETF flows, energy ETF flows, have been supremely negative over the last 1 year. You look at cumulative 3-year flows, and it's just off the charts negative. So, nobody wants to own these things. I believe the oil price is already priced in recession, whether we get one or not. And so, everybody is massively underinvested. Now, there's also the flip side, which, I believe we are already in a stagflationary environment of weak economic growth, rising inflation. the best sector to own in that type of an environment is energy stocks. And so I think people are going to come around to this idea the more that they come to the conclusion that, wow, we're in stagflationary environment. This is really not good for the profit margins of most companies. And energy is so beaten down right now that the opportunity to put something in the portfolio that is a good stagflation hedge, I think, is really compelling.
And I never thought I'd see rumors of BP getting bought out by Royal Dutch Shell or Chevron or ExxonMobil. And I've been asking around if the rumors are true, and my oil industry contacts are telling me they're hearing the same thing. I didn't think that the UK government would approve it. So, I mean, the large oil companies are looking around at mergers and acquisitions, discount assets now, because the assets are just deeply discounted that much that the BP takeover rumors are not just rumors, from what I'm hearing.
Yeah, no, I'm glad you brought up BP because it's not just Buffett buying Occidental Petroleum, and he also has a pretty big stake in Chevron. It's Carlos Slim, wealthiest man in Mexico, buying PBF Energy, a big refiner with exposure in California. And then you have at BP, you have Paul Singer, who's been buying, BP and Phillips stock. Obviously, he's kind of an activist investor who wants to kind of promote change such that it's going to realize the value that he believes in the shares. But it's not really a coincidence. I believe there's a macro play in addition to there being an activist kind of value play in BP that he sees a macro play that from a stagflation standpoint, putting something in the portfolio like BP and Phillips that kind of thrive in those environments has a bullish macro case behind it too.
Oh, are you talking about how oil companies see it's more liquid and there's larger pools of capital like generalist investors or hedge fund managers, easier for them to go and buy oil company shares as an inflation hedge than gold company shares, than gold stocks?
Yeah, absolutely. Right. I mean, there's no way that Buffett could buy precious metals, right? He has 350 billion in cash, and there's nothing big enough, that would put a dent in the portfolio. So, energy is 2.5% of the S&P 500 right now. It's like the lowest percentage it's been in forever. So that's just demonstrates that most investors, right, the average investor, the passive investor, is radically underweight energy right now. Now Buffett's allocation is significantly higher, that at least triple than what is in the indexes. But it's also important to think about what is the driver of that relative performance of energy. And as Jim Paulson pointed out on his Substack not too long ago, the two main drivers of the relative performance of energy are the trend in the dollar and capacity utilization. So you have it over the last 10 years, we've had a rising dollar, right, which is kind of a headwind to the oil price, and weak capacity utilization. The recovery in the wake of the great financial crisis has been really, really weak. And we've accelerated kind of the offshoring of production, the hollowing out of the manufacturing sector, these types of things, which has been tough. It's kind of suppressed capacity utilization. So to the extent now that we're entering an era that's an environment that's more characterized by dollar bear market, falling dollar, and increasing capital capacity utilization in the kind of manufacturing sector due to kind of the reshoring of production, the kind of building back up, reindustrializing of the economy. Those are the two factors that will drive a longer term bull trend for the relative strength of energy. And so I think that case has rarely been stronger than it is today. And the fact that energy is starting from such a tiny weighting in the S&P means it has a long way to run once it really turns.
Well, I also think natural gas and liquefied natural gas has a huge long-term bull market for demand for liquefied natural gas exports here in the US, and then also for data center demand in the US and European Union and China. So the data center build out, which is really just starting, I mean, these next generation data centers. So we've had these data centers in major cities and metro areas for like Netflix and YouTube for regular internet and social media, but we're going like an order of magnitude demand on the energy demand side for the next generation of data centers for artificial intelligence software.
Yeah, and it's not just data centers. Data centers have been like the big one that's gotten all the attention. But to bring it back to that reindustrialization, if we do need to, we do finally kind of decide that yes, we want, and I do think the deglobalization trend is a bipartisan thing. This isn't a Trump thing. This was, Biden also kind of held with the original Trump tariffs, and we realized that, yes, a lot of the, growth in populism and unhappiness among the American people is driven by this hollowing out of the middle class and offshoring production and these types of trends. So we need to bring it back to some extent. And I think that's a bipartisan kind of understanding. And so that reindustrialization, that renewing of infrastructure and all that is so energy intensive. And so it's going to put a big burden on all types of energy. So electricity production and fossil fuels, et cetera.
And to go back to your point there about the size of the oil companies being good inflation hedges for these larger generalist investors that are larger pools of capital, you talked about Warren Buffett having what 350 billion of cash in US Treasuries right now, his largest ever cash and treasury hoard. The market cap for Newmont Mining, which is one of the largest gold miners, is only $57 billion. That's not enough to accommodate Warren Buffett and other pension funds and generalist investors that want to build up a sizable position, but an oil company, an energy company would be able to accommodate larger positions there.
Absolutely, absolutely, and yeah, and so I think that's why you're seeing, these billionaire investors kind of start to really target energy. It's deeply out of favor, and it's probably the most effective form of kind of an inflation hedge, stagflation hedge that they're going to find in the markets.
Well, they have to work on cost cutting and being more efficient, better productive with the energy because a company like BP, I mean, like they've wasted on bad green energy and ESG investments the last 15 or 20 years. I mean, they've lost billions of dollars a year on these things. So they need to streamline these things and run them far more efficiently than they have in the past. I think I saw activist investors were buying enough shares to get board seats on BP so they could try to fix the company prior to the rumors of it being put up for sale and a takeover.
Yeah, Paul Singer is, probably the single best activist investor out there right now, and he's wielding a massive amount of capital. He has a terrific amount of sway. So, yeah, I think that the fact that he is targeting BP and Phillips right now, but BP is the one that's gotten more attention. It suggests that he sees the opportunity for all those things to happen, and actually, most of the companies have done that. As I said, they've been starved of capital for most of the past decade. So a lot of them have spent the last few years, with that the turnaround in the oil price from essentially zero to well over $100 a barrel a couple of years ago. Allowed a lot of them to take a bunch of free cash flow, pay down debt, and be a lot more responsible. That wasn't poured right back into production like it was in that 2010, 11, 12, 13, 14 timeframe when they invested massively in overproducing. They're not doing that. They're at a different part in the capital cycle right now where they have terrific capital discipline, which is why they're shutting in production right now. And so, yeah, I think they're in a stage right now where, yeah, they're shoring up. They've been shoring up the balance sheets, and they're much better positioned to kind of weather some weakness and allow in the shutdown of production because they don't have as much debt to service as they did a decade ago.
Well, I also think with the Permian Basin, I don't know if you saw the comments from the Diamondback Energy CEO. He basically said, yes, the prices are weak, but basically there's not the ability to keep growing production at anywhere near the growth rates of the past, that all the technological innovations with the horizontal drilling wells and the octopus pads, that they put straws into the ground and pull the oil and natural gas out faster. But basically now 15 plus years of drilling and production growth for the Permian Basin, we're starting to hit the limits. He said, I think in the last couple weeks, he said that production basically it'll be lucky to be flat or plateau going forward now in the Permian Basin.
Yeah, and I think that's a great point. I think that's we're at a different point in the site shale cycle too, where most of the easy fracking has been done, and over the past few years, what the companies have been doing is is focusing on the ones that are the easiest, easiest to drill, right? So they're shutting down production. They're going to shut down production on the ones that are the most difficult to drill. So to think that oil price goes up and then they can, ramp up drilling in any respect like they have done in the past is kind of probably unrealistic, because the wells that are left are going to be the most difficult to drill. And so that high grading of production means that the ability to ramp up production is really significantly limited by the difficulty of the wells that are left out there.
And we're at West Texas Intermediate just under $63 a barrel after rally. I think it was in the high 50s 10 days ago. I mean, we're not at a price where a lot of these wells, the tier 2 stuff, and these are not the best wells anymore, where the tier 2 wells are not economic to be drilled at the current price. I mean, we're going to need $80, $85 a barrel for some of those tier 2 wells to be drilled and to generate any type of free cash flow for the incentive. So the oil price is going to have to rally to the mid to high 80s in the next 12 to 18 months for some of those additional marginal oil production wells in the tier 2 Permian Basin to come online.
Yeah, I think, we're, like I said, I think the oil price is pricing in recession right now. The way the oil price typically trades, and maybe we've talked about this before, Jason, is a lot of people sell it, because, oh no, recession is coming. But as soon as that recession becomes consensus and people know we're in recession, the oil price bottoms or has already bottomed and starts turning higher in anticipation of the recovery and the fiscal stimulus and things that are coming to support the economy. So oil prices typically, bottom around the time of the onset of recession. So, with the way recession dating works, we might find out, let's say the recession the economy went into recession the start of this quarter, April and whatnot. We're not going to find out till it's closer towards the end of the year. And by then, if that's when the recession dating happens, for example, this is hypothetical, we'll look back and the oil price will be 80 or 85. And we'll say, wow, that's it. When it was 60, that was when recession started. And that was the message from the oil price at the time. But it already had, rallied strongly out of that by the time, they actually come around to dating it.
Now, I want to transition to the big technology companies. So the Mag 7, NVIDIA, their earnings, some of the announcements, their capital expenditure. Are we seeing signs that the big technology companies and NVIDIA are starting to slow down the capital expenditure that they're spending on artificial intelligence software and data centers, or are they not slowing down yet?
I think, I saw a statistic. I think it was, I can't remember who posted it. But it was in one of I think it was a Bloomberg report where they showed that this last quarter was the first quarter of actually a sequential decline in Capex spending. More interesting to me was the Tencent earnings call last week, where, to quote their, CEO, he said, over the past few months, we've started to move off of the concept or the belief of the American tech companies, which they call the scaling law, which required continuous expansion of the training cluster. So Tencent is basically saying DeepSeek was right? DeepSeek demonstrated you don't need anywhere near the amount of compute, the amount of data, the amount of, the size of the data center, the number of GPUs to create useful AI products. And so they're finding that, hey, they have enough. And Tencent has said, we don't really need to buy any more chips, because what we have is more than enough to meet our needs. And what they're focusing on is now the getting more and more efficient. And so they're finding that, for every time they can improve their, inference efficiency, it doubles. It means they need half as many, GPUs as they have. So I think there's some clear writing on the wall right here, which I think a lot of people believe the DeepSeek news was maybe a false alarm, and I think we're going to look back and say, no, that was the pin that pricked the AI bubble. Was DeepSeek saying, hey, look, you do not need to spend hundreds of billions of dollars to develop these things. In fact, with MIT is demonstrated that you can basically deduce the model by inferring the data from the model off one of these things, and build your own for less than a couple $1 million. So I think that's kind of where we're at with this thing is we're realizing that we do not need these massive models. That they're actually developing much smaller models that are more efficient at certain tasks, and that there's probably been an overbuild. In fact, Mark Benioff, CEO of Salesforce, admitted as much in an interview with the Financial Times recently, where he said, these technology transitions have to have a bubble involved with them, because it's not until you get this massive overspend and over build out of infrastructure that you actually find out what's useful and what's not. And so, I think we've seen a massive overcapacity, overbuild of what's actually needed to develop some useful products here. And we're going to see a digestion phase, whatever you want to call it. This is the history of technology, right? You look at the Gartner hype cycle, and it's very, very clear that we're entering in the down cycle of this hype cycle, where you get the huge boom and all the hype, the massive overbuild, and then you go through kind of a digestion phase, which lasts a few years. And I think that's where we're at now. And if that's the case, then we're going to realize a lot of this spending was misallocation of capital, and NVIDIA might, the revenue growth estimates for NVIDIA that say it's going to grow X amount, double-digit percentage from here to eternity, are going to have to be radically revised.
That's interesting, because we have what the Chinese tech companies are saying on one hand versus what Elon Musk and XAI are doing on the other, because he just scaled up the Colossus data center, which was the largest in the world, at 100,000 GPUs, NVIDIA Blackwell chips. They just scaled it up to 200,000. And the engineering designs, they want to go raise $25-30 billion for XAI and scale it up over the next 5 or 6 years to 1 million GPU chips in a cluster. So I know the US tech companies are saying one thing and the Chinese ones are saying another. There was a testimony, I don't know if you saw it, from a American tech company CEO in artificial intelligence. His name's Alexander Wong, and he claims that DeepSeek lied about their costs and the training of the models. He said that 50,000 NVIDIA Blackwell chips were bought on the gray market from Singapore, and there's criminal charges, felony ones for 4 people, and that I think they spent an insane amount of money, over $1 billion training the model. So when they claimed it was only 20 million or something. So there are innovations, but they're lying about the chips that train the NVIDIA chips and the cost.
Yeah, I mean, MIT says they replicated OpenAI's most highest level model for $2 million. So they can go and spend as much as they want on these things. OpenAI's most recent model hallucinates twice as much as the previous model. So I think what they're finding is that we're going to spend more and more, and this the scaling model is not getting. It's why OpenAI hasn't actually released GPT-5. It's why Llama, the latest Meta model hasn't been released, because they're not getting the performance gains. They're spending on the infrastructure, but they're not getting the performance gains. In fact, none of the performance is living up to anything that people hoped that these new models would show. So I think they're really running into a wall in terms of the performance of these things, and they still don't even they're not generating revenue. So I don't know how you go spend hundreds of billions of dollars. $500 billion is really what OpenAI wants to go spend with, Masasan, and when you don't have the revenue to support it. So, unless they magically find, a massive revenue generator to kind of support this, and even if they do, the fact that these expensive models lose money on every query, right? I mean, they're not. It's not like search engine, right, where it costs them almost nothing to run search queries. These queries on these models, because they're thinking models, and they have to not just assess the entire large language model to kind of come up with an answer. But then they can come up with 5 answers, compare them to it. It takes an enormous amount of compute for these top end models to even run one query. And so they lose a massive amount of money on every query. That's not a sustainable business model. So I think it's very, very clear that we're going to go through a phase where the reality of the finances of these things is going to come up against the ideas that they're going to continue to build out exponentially bigger data centers indefinitely into the future and get what they're anywhere close to what they're anticipating in terms of performance out of them.
Well, I think the data centers are already paid for, and the companies that are in charge of construction, they're really far behind. They're almost a decade behind on some of the orders building them out. So they've been paid for in a lot of cases, and they haven't even started building some of them. There very few of them are under construction right now. But you hit on an important point here that we've already gotten good productivity gains on the software, and it's starting to disrupt a lot of other industries. I mean, I think you're aware of this because you track the tech companies. They're firing thousands of people now, these computer programmers. Didn't Microsoft just say that 30% of their in-house computer programming now is already done via artificial intelligence software? So those are human computer programmers that they don't need anymore.
Yeah, there's a question about that, because when you listen to programmers, they say it really still takes a human because they, yes, they're more efficient at software, creating software than most other things, and that's been the main, probably the most efficient use for them so far. But they still hallucinate, and you still, there is a worry that if you allow, AI to create all the code, you're embedding who knows how many bugs into that code and problems down the line. It was interesting to me to see Klarna, big fintech firm, was one of the biggest adopters of AI when it first came out. In fact, they said they wanted to be OpenAI's guinea pig, number one guinea pig. And they tried to fire as many customer support people as they could and replace it with AI customer support. Well, the CEO of Klarna came out this last week and said, we've shut down all of our AI customer support because the quality went way down, made our customers unhappy, and now we're hiring back all those people and we're investing the future. He said the future of this company is investing in human, investing in our human ability to do customer support. So there's a number of stories like that too. I think what's happening with Microsoft is they're trying to demonstrate that, yes, they're trying to lead by example and say you can fire people and replace it with AI. But what is going on with Microsoft also is that the $80 billion a year of Capex is going to start to flow through the income statement in the form of depreciation, which is going to significantly reduce earnings. And so they have to cut expenses to try and maintain free cash flow. All these companies' free cash flow peaked a year ago. You aggregate all of these hyperscalers, Meta, Alphabet, Microsoft, their free cash flow peaked and is rolling over because they're spending so much on this. So they absolutely have to start cutting costs because the revenue side is not there. So, that to me, the cutting of employees is more of a sign that, hey, we can't generate revenue from this. We have to protect cash flow. So the only way we can do it is by cutting expenses.
And isn't Klarna, that's the buy now, pay later company that was debating going IPO, and I think they pushed it back or it's canceled indefinitely. I've heard stories too about like these artificial intelligence software, the chatbots, that humans figured out how to trick them, and they were getting like free vacations and stuff with Travelocity or something, that they figured out prolonged usage with trick questions and stuff like that. And they tricked the chatbots, the artificial intelligence software, into giving them comp vacations. So then the companies had to get rid of the artificial intelligence software because it was giving away all these free vacations and stuff and other free things.
Well, that's kind of what we're finding with a lot of these things. It's the reason why Apple has been not been able to roll out AI, right? And it's been such a disappointment, is because there are so many glitches with these things. They cannot get them to perform in the way that they've been built, right? I mean, in fact, the Better Business Bureau came out and said, Apple, we're going to downgrade your rating if you do not start, basically scaling back your bogus advertising about AI, right? Because you're saying it does all this stuff. And when people, there's actually a lawsuit against Apple right now and people who bought the new iPhones that don't do the AI that was advertised. So yeah, I think there's just more and more cases we're finding where yes, I use Perplexity all the time. I think it's way more valuable than just searching, Google or any other search engine, which to me says more about the risk to Google than it does about the profit potential. Perplexity has significantly negative gross margins, right? They're still losing tens of millions of dollars, but it's a great company, but they haven't found a business model. But at the same time, it is a dramatic threat to Google's business model, right? I mean, even Apple said for the first time they've seen Google searches, I think within iOS, decline year over year in the last couple of months, and it's people are using these, the chatbots and things, ChatGPT, rather than do Google searches. And I think that's fantastic. To me, I use it all the time. But the idea that we're going to have these, incredible AI advisors who are going to book vacations for us and do all this kind of stuff it's just not. It's not a reality that's going to be here anytime soon.
Yeah, especially in the short term. And I also use Perplexity. And I've spoken with the CEO in some emails and on X. He's actually working on a cheaper Bloomberg terminal. So that's better hardware and software. So I don't know how close they are, but they're working on a cheaper version of a Bloomberg terminal because how expensive it is. They want to offer it to regular people at a much more affordable price point, better hardware, better software integrated into it for research.
Well, as a Bloomberg user and a Bloomberg fan, I'd be very eager to see what they come up with. And but that's where the opportunity is for a lot of these things, is to disrupt, places like Bloomberg, right? I mean, Bloomberg's margins are off the charts, right? I mean, they have a monopoly essentially in providing, a platform to institutional investors and whatnot. There are opportunities for AI to disrupt a number of industries. I think that is the lesson of technology. Is that that people should be more worried about the disruption to probably the big tech companies than their ability to kind of use it to fatten their free cash flow.
So you would expect then that unless there's drastic changes to the capital expenditure or artificial intelligence software starts to really pay off with sales growth and better profit margins, that the free cash flow, at least in the short term for the next couple of quarters for the big tech companies, it has peaked already 12 months ago?
Yeah, I think it's peaking out right now, and we've seen that. I mean, Microsoft said we're going to do our 80 billion this year, but they're not going to grow capex beyond that. We've seen cutbacks. Microsoft has actually canceled leases for new data centers. We've seen the same thing from Amazon, who's been scaling back its intentions. So I do think there's signs. I mean, there's a data center in North Dakota that was a set up as a Bitcoin mining operation, but it's a monster data center that's sitting vacant, and they cannot find a tenant for it. Because I think the demand for the data centers is really starting to roll over. Meta reached out to Microsoft and Alphabet, said, "Hey, would you guys like to start sharing in our capex? Right, our Llama model is open source. You guys should start helping us pay to train these models." And obviously they were rejected, but it's a sign that Meta is even starting to recognize, hey, maybe we cannot afford to keep spending $100 billion a year on developing these things when we're kind of running into a wall of performance. I'll just say too that it was really interesting in the Cisco earnings call recently. He, the CEO said that he believes that these big tech companies are going to continue to hype the capex until they literally cannot afford to do so any longer. And it really kind of reminded me. Luke Kawa pointed this out in a piece that he wrote for. Where it's really reminiscent of the Chuck Prince quote, that we're going to continue to dance while the music is still playing in 2007, and then that was literally the top of the market, right? The subprime stuff began to melt down right. I mean, it was already melting down when he said that. So I think we're at a very similar time in that cycle where, yeah, they're going to still continue to hype it because they think the music is still playing. But I think it's very clear that yes, that they're not creating the products to generate the revenue to sustain the capex, and the depreciation charges are starting to mount in a way that's going to really start to hurt earnings. They're cutting capex, but they can only do that, or sorry, they're cutting expenditures, but they can only do that for so long before they hollow out the business too much. So yeah, they're going to have. I think they're going to have to all start reining in the capex, and that's not priced in at all.
And yet retail investors, I think, came in and bought S&P 500, NASDAQ 100, MAG 7 at record amounts over the last 6 weeks. I think $40 billion in a single month, the largest ever by the dip from retail investors over the last 4 to 6 weeks, was just astronomical. So I guess then people are not looking at the same fundamentals you are, Jesse. They're just betting on a stock market rally or Trump cutting the tariffs, or they're willing to pay a higher multiple for earnings that may be declining.
I just think, the sentiment behind it is this idea that the stock market always comes back, right? And to me, it's the inverse of the sentiment that we saw in 2009-10, right? If you were involved in markets back then, you remember in the spring of 2009, nobody wanted to think about the stock market. Nobody wanted to hear about it. If you brought it up, people would just respond with disgust. That I'll never own stocks again as long as I live. This is like the worst thing that's ever happened to me, was owning stocks over the last 2 years. We're at the opposite of that right now, where everybody wants. I mean, the household allocation to equities is the highest it's ever been, and everybody thinks that whenever the stock market goes down 5% or 10%, you just have to buy the dip because the stock market always comes back. Well, if you look back at the last two lost decades in the stock market, from 2000, 2000 to 2012, and before that, from 1972 to 1982. That first one in 72 to 82 was driven by stagflation, right? We had a bad stagflation problem, and that made it difficult for earnings to grow in any sustained way, and rising interest rates made pushed valuations lower. Stock prices went nowhere in nominal terms. And then the dot-com bust in 2000, from 2000 to 2003, and then stocks didn't recover for more than a decade after. I think we're potentially in the middle of a stagflationary scenario and another bust in the generative AI bubble. So, I potentially think that we could have a lost decade. Now, it's just ironic that people's sentiment is the exact opposite. The stock market has to go up indefinitely into the future because it always does. And I'm entitled to a 10% rate of return, not just on average over a long period of time, but every year, year in, year out. And that sentiment to me is a very bearish contrarian signal, especially at a time when I think the probability of a lost decade in stocks is relatively high.
You also had similar sentiment to add your points there about home prices too, for 3 or 4 years after the housing bubble burst from 2007, 8, 9, that in another 3 or 4 years, there was a lot of people saying, I won't buy a house again. The government was coming out with programs to try to get people to buy homes instead of renting. So they tried this, and then home prices went on a tear too after that because they put in zero interest rate policy. People refinanced their mortgages. They made it easier for people to get a low interest mortgage, a 30-year mortgage back then when interest rates were artificially low on that.
Yeah, I mean, in 2012, it was very much like, in real estate. I mean, banks were basically just giving houses away. If you came in with, an offer on a foreclosure, banks were just take it off our hands, please, at any price. And prices were down, 50, 60% from the peak in a lot of cases, in places like Bend, Oregon, where I lived at the time. I don't know if we're in for a real estate, bust like that again. I think it might be less likely this time just due to demographics and things. But housing is rolling over, right? I mean, it's getting weaker. Supplies are growing, and the buying interest is waning. He's here from the National Association of Home Builders saying that they're offering tons of incentives, and they still can't move inventory the way that they would hope.
Well, people can't qualify for a mortgage. People can't qualify for a mortgage, Jesse. I mean, like if the home builders are building new homes with these $1 million more McMansions or something in these areas, I mean, it's tough to qualify for a mortgage with
Yeah.
all the money down in your credit rating and stuff.
Well, not only that, they're paying down the interest rate, as an incentive to get people to buy them, and they still can't sell them. So, it's a problem. Housing is one of the most cyclical employment, sectors of the economy. So if they start laying off in the housing sector, it's going to be a very clear sign that recession is underway, and housing prices, are could weaken for a time.
Yeah, an official government recession versus reality is two entirely different things. I don't really trust the PhD economists. Look at what they do with the GDP, the jobs reports, the CPI. I mean, the jobs reports were revised down each month for over 12 months prior to the November 2024 election. That was ridiculous, the games with the jobs reports.
Yeah, yeah. I mean, with all the revisions and everything, it's kind of silly to, that's why you cannot rely on those things. If you kind of were just waiting for the government to tell you recession is underway, yeah, you're going to be 6 months late and many dollars short. At that point, I think you have to look at things like the oil price pointing to recession. The situation in the housing market is weak and getting weaker, and unemployment's been rising for 2 years now. I don't think a lot of people necessarily appreciate that, and the trends, and like the sentiment surveys suggest that it could weaken significantly in the months ahead.
So I want to ask you now, as an investor, which industries do you see are growing free cash flow, where insiders, the senior executives, are actually buying the stock on the open market? They think their stock is cheap. They're actually using their salary or cash that they have on hand in the bank account and going and buying shares, or they're doing share buybacks with free cash flow because they think their stock is cheap. Do you see any industries that have kind of at least one or two, maybe all three of those things?
There's not. I think there's select opportunities here and there, but there really isn't an industry trend that I've seen. I think generally when you try and aggregate it, the insider activity is still very bearish. Right? We saw a huge spike in insider selling relative to buying last year. That to me, it typically ranges over the past decade, in a ratio of 10 on the low side to as high as 30. And the only times we've seen it get close to 30 was literally at the end of 2021 and last year. For most of last year, we actually were above 25 in the insider sell to buy ratio. Now, this is, to me, this ratio is one of the best leading indicators of economic growth and corporate earnings over a 1 to 2 year time frame. So when insiders are really, really bearish, it's usually a good sign that a year from now, the economy and earnings are going to disappoint. Insiders got really, really bullish, believe it or not, at the end of 2022. And that was a really good sign that everybody thought the economy was going to go in recession. Everybody was bearish, the stock market, including myself. And insiders were saying, nope, recession is not coming. Stocks are cheap. And look at what the stock market has done since the end of 2022. It's gone, it's almost doubled. Pretty wild. But at the same time, really what set the stage for that bullish opportunity, the end of 2022, was the sell to buy ratio, the short term, the 13-week ratio plummeted in early 2022. So as soon as the stock market started rolling over in early 22, insiders changed their behavior, started getting really bullish, and that bullishness persisted for the whole year of 2022, where that short-term ratio stayed below 10, single-digit sell-to-buy ratio. The sell-to-buy ratio right now, this short-term one, is still over 20. We still haven't seen insiders, right? The stock market sold off hard into that early April low, but insiders never got bullish all the way through that. And in fact, with the sell to buy ratio still over 20, you could argue that they're still more bearish than they've been, during most of the time over the past decade. So to me, this is a sign, insiders, with the bearishness that we saw last year. In fact, that short-term sell to buy ratio last year went actually over 50. That's the highest it's ever been. A year ago, and that sell to buy ratio was over 50. So to me, that's the most bearish insiders have ever been. That's them saying the economy and earnings are going to radically disappoint this year. We haven't seen earnings estimates come down at all. And, stock market's still essentially, almost back to the highs, pricing in a soft landing or no landing in the economy. The message from insiders is dramatically different from that. As a group, the total selling and buying from the C-suite in the American C-suite is that they see probably a steeper earnings decline by the end of this year. So I think we're still pricing in 8% earnings growth this year on the S&P 500. Insiders are saying that's way too optimistic. It's going to be probably coming much lower than that, and stock prices are going to have to reflect that.
Well, the tariffs are a tax, so I don't think Wall Street is pricing all of this stuff in yet. They're not lowering price targets here with lower multiples or revising earnings yet, because I think that people just expect that the tariffs are going to keep getting pushed back. But the small business owners, I mean, I'm seeing people post like screenshots, the small business owners that were importing goods from China. I mean, they're getting hit with insanely high tax bills on the tariffs. So if you're a regular small business owner, your company's not publicly traded, I mean, you're getting hit right now with really high taxes from these tariffs.
Yeah, and obviously insiders, weren't kind of forecasting what the catalyst was going to be, but I think the trend in the economy is pretty clear. That right, we had a negative GDP print in the first quarter, right? That surprised everybody. Now a lot of that was imports and things to get ahead of the tariffs, kind of skewing the numbers. But even beyond that, you just look at the trend in growth, and I think it's clearly on a decelerating trend. We haven't seen unemployment rise in a way that would say, hey, recession is here. But it could be, as I mentioned before, you see a lot of these consumer sentiment surveys, and they're pointing to they're really worried about the labor market. That's usually a pretty good indicator that unemployment's going to rise, and earnings are going to go into decline. And so I think that's probably that broader trend of economic slowing and heading towards recession is what insiders have been pointing to. And I think the key point that I would make is that they haven't really turned bullish yet. Insiders are always early, right? Like I said, a year ago, the insider sell to buy ratio surged over 50. So that was April last year. And that was a very early kind of warning of kind of what to expect this year. They haven't gotten bullish yet. And so really what you need to see is insiders get bullish and know that that's early. It's an early signal that earnings and things could continue to trend, stock prices trend lower for a time before you see that kind of persistent bullishness among insiders really start to send a clear message that there's light at the end of the tunnel. Things are going to turn, and earnings are going to actually outperform and expectations in the quarters to come. We're nowhere kind of near that situation yet.
Yeah, it looks like government spending cut. A lot of large corporations are dependent on government contracts. The consumer in a lot of industries, Jesse, looks like they don't have the savings and the discretionary income. You talked about the lack of home purchases. I mean, we could talk about auto loan delinquency, credit card debt. Those things are not conducive to a lot of consumers having the discretionary income to go and spend. I'm seeing a lot of people that are worried about their jobs, that have six-figure jobs, that are worried that they could be cut back on their hours or fired and then have to get a lower paying job. But the industry, Jesse, I think that's actually that has the free cash flow growth, at least over the last 12 to 18 months, substantially compared to the past. The companies are using free cash flow to buy back their shares. They're looking at potentially increasing dividends or going and buying, hopefully don't do bad acquisitions. The only industry I can think of right now, and it's not large enough to be a large one in the S&P 500, is the gold mining ones. So if the gold miners are the only industry where all these nice things are happening from a fundamental standpoint, the operational part of the business with free cash flow growth and share buybacks or dividend increases or mergers and acquisitions, those things, insider buying, the economy is not in the best of shape right now if the gold miners are looking like the best industry.
Yeah, and I would just point out too that with a sector like the gold miners and very similar to like a sector like the energy stocks, the time to buy them is not when things look fantastic. The time to buy them is when things look dismal, right? Because at the very top of the cycle, and I'm not saying gold miners are at the top of the cycle by any stretch. I'm just saying that they're not at the bottom of the cycle. At the bottom of the cycle for the gold miners, things look horrible, right? Free cash flow is terrible, and the price earnings ratios are very high. That's the kind of what you look for at in a bottom in a cyclical sector like this. With energy, right? That's kind of what you have is the PE ratios probably look a little higher than they should because the earnings are depressed by a lower oil price. Things look dismal. So I would just say that like you have to be careful. When everything looks good, a lot of the times that's priced in. And so the question for me is what's actually priced into the gold miners, into their shares right now, and I don't know the answer to that. I just know that from with the way things look for energy right now, they're much more likely to be closer to a cyclical bottom than the gold mining stocks.
Well, I agree. Oil will bottom in the not too distant future. And I think that from a sentiment perspective, it is deeply negative. So as a contrarian, yes, I agree. Platinum group metal miners, for platinum and palladium, I mean, I think like that's been in a bear market for a couple of years now. I think they're below cost. The platinum and palladium miners are below cost. Oil is at very negative sentiment. I think I saw a sentiment indicator that said it's 20 years. It's the lowest, most bearish sentiment in 20 years for oil, whether that's on the oil futures contracts and the oil shares. But for gold miners, Jesse, I'm looking at the GDX, which is the largest gold miners ETF. It's at $47 a share. Its all-time high was 65 back in 2011 when the gold price was way lower. The gold price was like around 2000, 1900-ish. And we're at $3,200 gold. So I wouldn't say that the sentiment is particularly bearish for bullish for the gold miners right now because we're, 25-30% off the all-time highs from 2011 for the gold miners ETF.
Yeah, no, absolutely. I'm not. Don't get me wrong. I'm not bearish on the gold mining stocks per se. I think I would just point out that the time when there was a really compelling buy was look at that oil to gold ratio, and it spiked higher in 2022, suggesting that oil was really expensive relative to the gold price. Gold price was really cheap in 2022 relative to the oil price. Where were the gold miners back then? $22 a share. They bottomed in late 2022, and nobody wanted to own them. Right? They're up well over 100%, 150% off those lows. So, they're definitely, I don't think they're anywhere near kind of out of favor, and it's the buying opportunity kind of like we saw back in 2022. For me to get really bullish on the mining stocks again, I'd want to see that type of a scenario again, where it looks to me like the gold price is cheap relative to other commodities, other oil. I think the thing is about gold is gold leads the rest of the commodities space. So the run in gold right now to me is suggesting that the rest of the commodity space is going to follow, over the next year or two. And if that's the case, then that's what you're going to want to own is the ones that are undervalued right now and are going to follow the gold price higher over the next 12 to 24 months.
Yeah, I don't know if you saw David Einhorn's new letter. I was reading summaries of it. He's talking about what $30 to $100 gold that based on DC budget deficits, both political parties in Congress and the debt ceiling being raised, that they simply will not cut spending under any circumstances. And he thinks that around $4,000 an ounce gold in the not too distant future is very, very reasonable.
Yeah, I think from a trading perspective, it wouldn't be. This is what maybe a lot of people who are maybe new to gold don't necessarily appreciate is that if you look back at like 2006, right now gold is one of the other valuation things I look at, or gold to oil. Is you can look at gold relative to real interest rates. I think I mentioned earlier that I look at TIPS yields compared to stocks. Well, you can look at TIPS yields, real interest rates relative to the gold price. When real interest rates fall, it's usually a great driver of gold prices, and vice versa. Real interest rates rise, that's bearish for the gold price. So, back in 2006 was the last time we really saw gold get as overvalued as it is today relative to real interest rates. Real interest rates have been flat for about a year. Gold price is up 40%. So that suggests gold price maybe outran one of its primary fundamental drivers. So if you had just another 2006-7 was kind of a correction within a bull market, but you had a similar correction in the gold price, it would take it back to about $2,700 an ounce. And I don't necessarily think that a lot of gold bulls are prepared for that type of a consolidation, which could easily happen. I mean, during bull markets, you have those kind of pullbacks all the time, and that wouldn't be out of line with gold's fundamentals. And so I think that, yes, I don't disagree with David Einhorn. It could be 4,000, but it also could pull back to 2,700 very easily. So what I want to use to kind of, and I've been massively overweight gold for the past, number of years. Like I said, in 2022 was a terrific buying opportunity. But right now, I want to be relatively underweight gold to things that I think are more out of favor and undervalued.
And we had you on for interviews over the last couple of years, and you were talking about gold being out of favor, and gold was a good purchase back then, especially some of the gold stocks. But gold in general, gold exposure was way, way out of favor back then. I mean, I think we're in a different, you compared like the 2006 and 7 time period. I think we're in a different macro environment now with all these bad policies, the size of the national debt, the size of the budget deficits, the interest payments. I honestly think the macro trade, Jesse, is that these non-G7 central banks, post-Russia sanctions, 3 full years now, seeing the size of the national debt budget deficits, they've just decided that they're not going to be buying US Treasuries in the size and that they're dollar cost averaging each month gold tonnage instead. I think that's the main macro trade. And I think the gold price is reflecting that. A lot of people haven't understood that because I see a lot of, macro experts, that I'm using air quotes here. A lot of them are current or former bond fund managers at a bank. They're pro US Treasuries, pro bonds. And so they've been like trying to pick tops in the gold price every month for the last couple of years. They've been wrong because they don't see any of the things that I highlighted, that these other central banks have just decided that they don't want to accumulate massive amounts of treasuries, that they want to start dollar cost averaging gold. And I think that's what a lot of the main people on Wall Street and money managers have missed.
I absolutely agree with that. And I think what people might be missing today is that other central banks, and particularly the Chinese, may decide that it's not just gold is the only way we can do this, that we can build up our oil reserves at a time when oil is really cheap relative to the gold price. They can be opportunistic into what commodities they want to stockpile and when.
Exactly. China has a history of this with picking out which, I mean, if they're going to pick out what's cheap, they should go buy platinum and palladium. I hear that's what the jewelry demand. The jewelers in China are switching over to platinum and palladium jewelry because now, like, the platinum and palladium prices are below the mining production costs. I mean, how much more sustainable is that? They've been in a bear market, platinum and palladium, for the last 3 or 4 years.
Yeah. Yeah. I mean, I think it's probably, like I said, I keep coming back to this theme of commodities broadly. I'm a bull on all of these things. I think gold is going to be significantly higher years from now. I just think in the very short term that I'm not the only one thinking this way. That probably the Chinese think too. Okay, look at this run that gold has had. We can continue to de-dollarize, and one way to do that would be to build up oil reserves.
And it also sounds, to your point, Sarah, like the retail investor, the high net worth person in China, not the Chinese government or the Chinese military that has bought gold in the gold tonnage in the past, that the jewelry investor in China is switching away from buying gold jewelry at the moment, and they're starting to look at silver and platinum and palladium because the metals ratios on a relative basis. I mean, we're at a record for the gold to silver ratio too. Like was 100 to 1, I think, at one point, or over 100 to 1 a couple weeks
Yeah.
ago.
And right, I mean, and silver, and that's actually one of the bullish sentiment indicators is you normally see silver dramatically outperform to the upside in these tops in precious metals. That's the one thing to me that we haven't really seen. That's why I'm not necessarily bearish about the gold price. I want to pick things that are relatively cheap. To actually get bearish on gold, I'd want to see silver outperform to the upside. Before this precious metals bull market is over, you will see silver dramatically outperform to the upside. And so I think, yeah, if you are a precious metals bull, you probably want to be favoring silver for sure.
Well, please tell my listeners more about the Felder Report and your podcast.
Yeah, the felderreport.com is just my website where I publish a number of different reports and products and things. I do a free blog post every week. Usually that just features kind of the 5 things that I found during the week that I found the most interesting. It's usually a couple of articles, maybe a chart or 2. And like I said, that's just a kind of a free blog post I put out weekly that you can sign up for there on my website. I'm also on X and Blue Sky. It's just at Jesse Felder.